Today we dissect the latest finance data from the RBA and APRA for the month of December. Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics. The last working day of the month is a big day for data. And so, on the 31st of January 2018, we had the December credit aggregate data from the Reserve Bank of Australia and also the monthly banking statistics from APRA, the banking regulator. Looking at the RBA data first, they reported that lending for housing grew 6.3% for the 12 months to December 2017. That's the same as the previous year, and the monthly growth was 0.4%. Business lending was just 0.2% higher in December and 3.2% for the year, down from 5.6% from the previous year. Personal credit was flat in December, but down 1.1% over the past year, compared with a fall of 0.9% last year. This is in stark contrast to the payday lending sector, which is growing fast at more than 10%, as we discussed on our blog yesterday, and that data is not included in the RBA dataset. Also, a further 1.1 billion of loans were reclassified in the month, we guess perhaps from AMP, between investment and unoccupied loans, which made the investor totals larger. Total credit grew 0.3% in the month and 4.8% for the year, so mortgage lending is still supporting overall loan growth, lifting the record household debt even higher. We still think we need tighter regulatory controls, especially as the cost of living continue to outstrip wage growth and mortgage stress grows, as we recently discussed. The annual trends show that investor lending is slowing, but just a little, but it still stands at 6.1% seasonally adjusted, and owner-occupied lending is running at 6.4% over the last year. 34.1% of loans are for investment purposes, and the value of owner-occupied loans was 1.13 trillion, up 6.3 billion or 0.6% seasonally adjusted, and investment loans were 587 billion, up 2 billion or 0.3% seasonally adjusted. Other personal credit was 151 billion, down 0.2% or 0.3 billion, and business lending was 908 billion, up 0.8 billion or 0.1%. Also, the data contained various health warnings. The RBA said historical levels and growth rates for the financial aggregates have been revised owing to the resubmission of data by some financial intermediaries, the re-estimation of seasonal factors, and the incorporation of securitization data. And following the introduction of an interest rate differential between housing loans to investors and owner-occupiers in the mid-2015, a number of borrowers have changed the purpose of their existing loans. The net value of switching of loans from investor to owner-occupier is estimated to have been around $62 billion over the period from July 2015 to December 2017, of which 1.1 billion occurred in December. So more than 10% of investment loans have been restated, and the process still continues. So the question we have to ask ourselves is, how certain can we be of the true numbers? So now to the APRA data, which looks at the total loan portfolios of the banks and which are not seasonally adjusted. The latest data from APRA, the monthly banking statistics for ADIs, shows a growth in total home loan balances to 1.6 trillion, up 0.5%. Within that, lending for unoccupied rose 0.59% from last month to 1.047 trillion, while investment loans rose 0.32% to 553 billion. 34.56% of the portfolio are for investment purposes. The monthly ADI trends shows these movements clearly, and the blip last August was CBA adjustments. Growth accelerated across all loans and within each type. The portfolio movements within institutions shows that Westpac is taking the lion's share of investment loans, and we suggest this involves significant refinancing of existing loans, while CBA investment balances fell, and most other players were chasing unoccupied loans. Note the AMP bank adjustments, which looks like a reclassification exercise, and which will of course distort the numbers. And remember, 1.1 billion were reclassified in the month, as we discussed earlier. Overall market shares remain stable, with CBA holding the largest share of owner-occupied loans and Westpac leading on investment loans. The 10% speed limit for investment loans is becoming less interesting given the 12-month average growth rate of 2.4%, and all of the majors are well below the 10%. Westpac is the major growing its investment book fastest, while CBA is in reverse. Clearly, different strategies are in play. So standing back, the momentum in lending is surprisingly strong and reinforces the need to continue to tighten lending standards. This does not gel with recent home price falls, so something is going to give. Either we will see home prices start to lift or mortgage momentum will sag. Either way, we are clearly in uncertain territory. We publish our Household Finance Confidence Index shortly, where we will get an updated read on household intentions. If you found this useful, do like the post, subscribe to receive future updates, and post a comment or a question. We will do our best to answer them. We certainly read them all. I'm Martin North, Principal at Digital Finance Analytics. Thanks for taking the time to watch.